Brent crude fell more than 5% on Monday to below $99 a barrel, and the ASX's energy sector dropped 2.3% the same session, but the capital-leaving energy names did not exit the market. That asymmetry is the day's central question. Trump said on Sunday that a deal with Iran was largely negotiated, and traders began unwinding the fear premium that had been embedded in oil since the Strait of Hormuz closed 3 months ago. What matters for Australian portfolios is not the oil price itself, but where the exit from energy landed. Qantas climbed close to 5% as lower fuel costs repriced the carrier's forward cost structure. Domestic institutional buyers absorbed the energy sector's release, rotating into consumer-exposed names with direct leverage to cheaper jet fuel. That move was straightforward. The harder read is in what the International Energy Agency said last week. Even if a deal is signed Monday, reopening the strait requires a minimum 2 to 3 months before export volumes normalize, meaning the fear premium that just unwound was priced against a timeline the physical market and not yet deliver. Secretary of State Rubio confirmed in New Delhi that the U.S. will explore alternatives if talks fail, and Iran's Tasnim agency reported that Tehran has made no commitment on uranium disposal. So the ceasefire frame that moved oil 5% rests on a deal that has not yet been signed, let alone certified. The ASX Energy Index absorbed a 2.3% loss in a single session on the basis of a social media post, not a signed agreement. The question that energy's sell-off does not answer is where the 3 months of accumulated inflation premium is actually going, because if the deal stalls, the oil trade reverses fast, and the ASX names that benefited from today's rotation face the largest retracement risk. The All Ordinaries Gold Index jumped 5% Monday, and Northern Star Resources rose 5%, while Evolution Mining gained 4%. Moves that read at first as a simple safe haven bid, but are structurally the opposite of that. Gold is normally bought when uncertainty rises. On Monday, it rose as uncertainty around Iran appeared to fall, which means the capital entering ASX gold miners was not buying protection. It was repositioning out of oil-linked inflation bets and into assets that benefit from the secondary effect of cheaper energy, lower input costs for energy-intensive gold extraction. Spot gold itself held above $4,500 per ounce, because even as oil's fear premium compressed, the broader inflation regime that has kept gold elevated since February has not materially changed. Australian monthly CPI is expected at 4.4% for April, down only marginally from 4.6%. That is the mechanism deepening. The Iran deal does not resolve inflation. It changes the composition of its drivers. If Hormuz reopens and energy costs fall, the RBA's trimmed mean CPI, forecast to remain above 3% until mid-2027, remains sticky from services and housing costs, not energy. Gold at $4,500 does not fall because oil falls. It falls only if the broader inflation regime breaks. Offshore institutional capital, which drove the bulk of the gold sub-index volume on Monday, was not exiting the inflation trade. It was rotating within it, from energy-linked inflation exposure into extraction margin inflation exposure. Haranga Resources, a small-cap gold developer with a newly JORC-compliant 402,000-ounce resource at Lincoln, California, captured the tail of that rotation. Shares up 27% intraday on volume that far exceeded its typical session. The positioning signal is that institutional rotation into the major gold names created enough slippage that speculative capital filled into smaller gold developers, compressing the risk premium across the gold sector rather than concentrating it at the large-cap end. What this rotation leaves unresolved is the domestic capital allocation framework, because a simultaneous regulatory shock has changed the relative attractiveness of the other major Australian asset class, and that shift operates on a longer horizon than the Iran deal noise. The Albanese government's budget has removed the 50% capital gains tax discount for most asset classes from July 2027 and has limited negative gearing to new residential bills, changes that directly compress investor borrowing capacity by an estimated 20% before any change in income or interest rates. That 20% figure is the structural force the day's gold and energy narrative does not price. A mortgage broker analysis published Monday showed a single investor earning $100,000 gross, who currently qualifies for $750,000 investment loan, will qualify for $600,000 under the new serviceability calculations, because lenders factor projected negative gearing tax benefits into the upfront borrowing assessment, and those benefits are being removed for established property. The tightening arrives on top of 3 RBA rate hikes this year, which have already cut youth employment by 56,000 jobs in April and pushed youth unemployment to 11.1%, the highest since 2021. The institutional response to the budget is visible in Charter Hall's session. Shares ripped more than 6% after the property fund manager posted its third guidance upgrade of the year, with record $6.5 billion in inflows pushing funds under management to $75 billion. That move is not a contradiction of the budget shock, it is its direct consequence. Retail investors facing tighter borrowing conditions and a higher CGT burden on direct property are rotating capital into unlisted real asset funds, where Charter Hall collects the management fee and the inflation hedge characteristics persist without the direct ownership tax drag. The budget has not reduced property capital, it has redirected it from leveraged individual landlords to institutional fund managers. The ASX's materials sector, up 1.9% Monday, drew additional support from the China coal mine explosion in Shaanxi, 82 fatalities and safety violations that may tighten Chinese supply, but that was a one-session positioning event, not a structural frame. The dominant reading today, the Iran peace deal signal has moved asset prices faster than the physical reopening can follow, and the budget shock is accelerating a structural allocation from direct property into institutional real assets and gold. The verification point is Australia's April CPI trimmed mean print on Wednesday. If underlying inflation holds above 3% month over month, the RBA June meeting becomes the session that tells whether the energy price relief changes anything in the rate path, or whether the inflation regime that has sustained gold at 4,500 simply reroutes through services. The unwinding of Monday's energy sell-off reverses if Hormuz remains physically closed past July, and the gold trade weakens only if trimmed mean CPI surprises materially to the downside, breaking the inflation regime that today's rotation treated as the persistent frame. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.